Well, welcome back. Futures are indicating a gain at the start of trading this morning ahead of the May jobs report out in about 9 minutes. The Dow Industrials right now up 138. That is just off of the highs of the morning. The Nasdaq's up 63. The S&P higher by 17. Here are the expectations for the May jobs report. We are looking for 190,000 new jobs to be added to the economy in the month of May. We are expecting the unemployment rate to tick higher to 3.5%. This is all from the analyst and economist community. Joining me right now is former White House Counsel of Economic Advisors, acting chairman and University of Chicago economist Tomas Philipson, ZipRecruiter chief economist Julia Pollack, Job Creators Network president and CEO, and the author of The Real Race Revolutionaries, Alfredo Ortiz, and Laffer Tangler Investment CEO and Chief Investment Officer Nancy Tangler. With us as well all morning long is Joe Concha and John Lonsky. Great to see everybody this morning. Thank you so much for being all hands on deck this morning with the jobs numbers. Tomas, beginning with you, what will you be watching for in this jobs number out in 8 minutes time?
Yeah, we saw yesterday the private employment numbers, kind of a blockbuster, but what was in that was essentially leisure and hospitality growing, which is kind of indicative, I think, of this labor market, which has not yet caught up in terms of pre-COVID levels. So people say this is a great labor market, and people confuse that a tight labor market is a great labor market. It's not a great labor market because labor force participation is way below pre-COVID after rising under Trump and declining during Obama, and productivity is way down. So we have fewer workers in there, and they're less productive in this labor market, and that's one out of two reasons. The productivity and inflation are obviously why real wages has been declining for the last 2 years. So I think it's misleading to think that this is the bright spot in the economy. It's not the bright spot, and I think we're going to see declining numbers coming down on the last 4 months trend that we've seen so far.
Yeah, it's interesting that wages are declining the last 2 years, Tomas, but even so, they're rising faster than, slower rather than the rate of inflation.
Yeah, there's two forces essentially. Productivity is going down, which means, real output per worker is going down. That's why workers are partly getting paid less. But also inflation is hitting them at the same time. So both forces are acting to make people poorer in terms of purchasing power. So I don't understand, honestly, why people think this is a great labor market.
Julia Pollack, where are the jobs today?
So the service sector was extremely active in the last month. There was huge growth across that sector. The production sector is the one to watch. Manufacturing tends to be very, very interest rate sensitive. So far, despite shrinking activity in manufacturing, despite sharp declines in new orders, companies are still adding workers just to deal with the backlogs that built up during the pandemic. But how long will that last?
Yeah, good point. Alfredo, same question for you. Can you identify for us where you think the jobs are today and where they're going?
Yeah, Maria, it's interesting. Like Tomas actually said, I don't know why people are actually saying it's such a great labor market. We actually went back this week and looked at the JOLTS report. And if you actually look at that, the quit rates are actually down 20% versus a year ago, and are actually almost at pre-pandemic levels. So employees aren't feeling as good about being able to move around from job to job. So that wage inflation really isn't as strong as it is. And also, if you look at it on a regional basis, the quit rates are actually the highest overall in the South, which of course are Republican-led states like Georgia, Texas, and Florida. And they're the lowest, actually, almost by 30% in the Northeast. And so overall, in addition to that, these job openings are actually disproportionately in smaller employers between 1 to 9. And so no two job openings are necessarily the same. And really, the health of the job openings aren't necessarily the same either.
Wow. Yeah, all really good points. And you talk about those ultra small business, Alfredo, that's what we're worried about because of the regionals, right? I mean, the banking stress that we've seen, the regionals are banking 90% of small business. That's another pressure on small business.
That's right, Maria. And in fact, 2/3 of our small businesses that we polled in our monthly Small Business IQ poll actually feared that because of the Biden economy and inflation, they might have to close their doors. And in addition to that, now 2/3 are really concerned about accessing credit because of the tightening credit market.
Yeah, and we saw a spate of bankruptcies just in the last couple of weeks, actually.
Right.
Nancy Tangler, tell me what you're looking for. What's most important from your standpoint, as you've got to allocate money to the market and also be aware of what this report is going to mean for the Federal Reserve, right?
Yeah, absolutely, Maria. Thanks so much for having me. I agree with much of what has been said, that the labor participation rate is going to be super important. We know that real wages are down, as has already been mentioned. What was interesting to me yesterday was productivity is again negative, but unit labor costs were stronger than expected as well. So that does not bode well for the long term if we can't get productivity up and real wages rising. So we're looking to see, I'm watching the average hourly earnings, and also the participation rate is very important. And that will influence how we allocate capital going forward. But as you know, we think the solution to the lower productivity that we've been experiencing is investments in technology, not just AI, but cloud, software, across the board. So that will influence our continued investment in that space. And last thing we'll be watching is, any indication of growth in the higher paying jobs. I mean, we know that leisure and travel are where we've seen the jobs, low paying, labor intensive. We want to see if there's a mitigation of tech layoffs and an acceleration in that space.
It's a great point, Nancy, and your point on technology also really resonates, because I feel like that's what's moving this market. I mean, this market would be flat without all of this investment in AI and in tech. Isn't that right? You've got a handful of stocks driving the NASDAQ. It's up 24+% year to date, largely on these expectations over AI.
Yeah, no, you're absolutely right. And I think it needs to take a pause in technology, that is. But there are other areas within technology that have lagged. And one of the groups that has come on pretty strong lately is semiconductors. And so we've been investing in the space last fall. Now we've been taking some gains, but that doesn't mean we're exiting. We're still overweight technology because the secular tailwinds are so powerful, one of which is improving productivity.
Wow, these stocks are unbelievable year to date. Amazon up 43% year to date. Meta up 120% year to date. John Lonsky, we are a minute and a half away from the number. What's most important to you in this May jobs report?
Well, of course, we're going to be watching at the overall increase in payrolls. I think it's important that it doesn't exceed 250,000. If that's the case, then perhaps the Fed might be compelled to hike rates come June 14th. Taking a close look at the distribution of jobs growth, like the equity market, the job market of lately has suffered from what might be called bad breath. And that is that we have an unequal distribution of jobs growth. Jobs growth of late has been skewed towards lower paying occupation groups in healthcare, private education, leisure, and hospitality. On productivity, a good example of why productivity is declining comes by way of comparing the much slower rate of GDP growth, real GDP growth, with jobs growth. First quarter, we had real GDP growing by only 1.6% year over year, while jobs grew at a rate that was faster than 2.9%, 3%. And you can't have payrolls outpace GDP indefinitely. There's a price to be paid for that ultimately.
Market is about to react to the jobs numbers. It's going to be hitting the tape imminently, and Cheryl's going to have the number for us. Expectation, 190,000 jobs added to the economy in the month of May. Let's get to Cheryl with the numbers right now. Cheryl.
All right, so we're coming in pretty hot here, guys. 339,000 non-farm payrolls added for the month of May. The unemployment rate ticking up more than expected to 3.7%. The street was looking for 3.5%. And remember, we were at 3.4% for the month of April. So again, for May, non-farm payrolls coming in much hotter than expected, 339,000. The expectation, as you just mentioned, Maria, was only for 190,000. And the unemployment rate ticking up again to 3.7%. Now, average hourly earnings, lot of talk about this on the panel. 4.3% year over year. That's a little bit weaker than what economists were looking for, 4.4%. That's the year over year average hourly earnings. So let's go down and look at some of the other numbers here. Let's get down into the private payroll number. That private payroll number, that came in at 283,000, and the street was looking for 165. Now, going into factory jobs, a loss of 2,000 factory jobs. We were actually looking for a gain of 6,000 there. Government jobs, we added 56,000 government jobs. That's a pretty big number. We don't get estimates for that. But if you look at the year, the month prior, it was only 23,000. So we more than doubled jobs for the government month over month. Non-farm payrolls, again, that 339, pretty strong number, everybody. As far as month-to-month average hourly earnings, 0.3%. That actually is in line with expectations. And the work week, the average work week for all private workers, 34.3. That's slightly less than expected. 34.4 was the expectation there. Labor force participation rate, 62.6%. For labor force participation rate. That is something that Nancy Tangler had also mentioned as well. The U6, we always look at U6. That came in, that's the underemployment rate. That's at 6.7%. So again, these are the headlines that are coming out of this report. I'm going to dig into the report as well and tell you exactly what the government is saying about where the strength was. I have a feeling, once again, as we're going into the summer month, it's probably going to be leisure and hospitality. Okay, here's what the report says. Job gains occurred notably in professional and business services, government jobs. I just gave you that number. That was a pretty big one. Healthcare, construction, transportation, warehousing, and social assistance. I'm wrong. I thought for sure it was going to be leisure and hospitality. I'm going to send it back to the panel, Maria, to all of you for a reaction. I'm going to go through and dig into the report and give you some more of the nuts and bolts of it. But again, that's a hot number, that 339.
Yeah. It's a hot number.
Yeah.
Markets initially traded down, but are back up to where we were before the number, with the Dow up 173 right now. We are all zeroing in on whether or not the jobs created are low-paying jobs, or are they actually higher-paying jobs. Tomas, this was something that you mentioned right off the bat this morning, that the leisure area is largely low-paying jobs. It looks like we do have professional services and business services creation here. Your thoughts on this number?
Yeah, it's certainly hotter than expected, and I think, this will bring into light whether the Fed is now going to, we have a 75% chance in derivative markets that the Fed is going to stop. This is going to probably move that down a little bit, given what's going on. Markets doesn't seem to react, and actually going up. The futures market is actually going up right now, so they don't seem worried as much about that. But this is a surprising upswing, I think, relative to the last 4 months.
Yeah, John Lotsky, your thoughts?
This is perhaps more in the way of labor hoarding. We still see payrolls, I believe, growing much faster than the underlying economy. As I stated earlier, this is an imbalance that will prove to be unsustainable. Companies will eventually find themselves overstaffed, too many employees, and they'll have to start making cuts perhaps in the final quarter of this year. And that happens to coincide with the Fed's expectation of a mild recession.
Joe Concha, this is the kind of report that will likely trigger Joe Biden to take a victory lap. Even though we know that inflation is eating into people's savings, but you don't see that in this number.
Oh, from a political perspective, I would imagine we'll see the president in front of microphones this morning, obviously touting this number. But I'll share a stat with you here, Maria, and it really is incredible. The jobs count has now beaten estimates 14 of the last 17 months. So we thought we were going to get a number here. It ends up being here. In this case, in the month of May, we're talking about 140,000 more jobs added than was expected. It is amazing how the estimates, people keep getting the estimate wrong.
Well, listen, this is good news for American families, isn't it, Alfredo?
Well, it is, but it isn't, Maria, because, again, you still have inflation eating away. If you look at real wages, we're still not keeping up with inflation. And so the living standards for the average American is still down. Remember, over the past 2 years, inflation is still really up more than 15%. So even though the rate is decreasing, we're still, suffering from the Biden inflation. And again, people aren't actually spending more necessarily out of their wages. They're actually putting it on their credit card, very much like the federal government puts it on their credit card. The average Americans are really living day to day off their credit cards, and their savings now are pretty much at historic lows.
Yeah, that's a great point. Cheryl, I know you've got more, but talk to us a bit about these wage numbers. You said that the average hourly earnings were up 4.3% year over year, Cheryl.
Right.
But inflation's up higher than that.
Absolutely. And so what you're seeing is, what we were looking for was, those lower paying jobs, which a lot of times is the leisure and hospitality numbers. Those were actually weaker than expected. The government job, again, that was a big number, but a lot of these professional and business services jobs, those are somewhat higher paying jobs. And that was actually a pretty strong number. The leisure and hospitality, I want to dig into that, though, because of that lower paying job talk that we were having a few moments ago. It trended up it's 48,000, right? But the 12-month average for leisure and hospitality jobs, Maria, is 77,000. So we've actually seen, which, again, that surprised me a little bit going into this report, because that's where I thought we would have seen more strength as we're going into the summer months. I don't know if maybe the restaurants and grocery stores are having a tough time hiring. We've had some guests like John Catsimatidis tell us that's a possibility here.
That's right. Good point.
But but as far as I'm looking at here, a lot of the jobs that are added, the strength in the report are these higher paying jobs. And again, I go back to business and professional services, another pretty strong number. That was 64,000 jobs. And that was strong the month prior. So that is a higher wage.
Yeah, for sure. Let's go to Julia Pollack. Julia, your thoughts?
This is a very mixed report. This is not a knock out the park. While the establishment survey shows this enormous blockbuster job gain, the household survey actually shows that the employment level declined by 300,000 and that the number of unemployed Americans rose by more than 400,000. There's a huge increase in this report in the number of job losers. Now, usually we're stuck in the establishment survey because it's based on a much larger sample and it's less volatile. But the household survey tends to be more sensitive on the way down. And so I would caution policymakers to realize that we're not out of the woods, and many of the leading indicators are concerning at the moment.
Wow. Nancy Tangler, how do you see it?
Well, I actually thought it was a fairly decent report. Just beware of the revisions. The revisions over the last 2 months are 93,000. So actually jobs were, non-farm payrolls were stronger last month than indicated. So we're paying attention to that. But also the participation rate is a real disappointment. John Lunsky and I may be the only baby boomers that are still working. I don't think you're going to be able to lure that group back in. Their financial position in terms of assets and overall and balance sheet is much stronger even still than it was pre-pandemic. So I think we're going to be stuck with this limited labor force, and that is over time going to be problematic. But again, force companies to solve their problems with productivity enhancing technology.
Yeah. Maria, 93,000 more jobs. I want to pick up on what Nancy is saying here. For March and April, 93,000 more jobs created. The revision was much higher. So that's a good point that Nancy's making.
Mm-hmm. John Lonsky.
Well, I think there are more baby boomers still working than you realize, Nancy. I don't think we're alone. We might have more companies soon if inflation continues to stay at a level. And one thing we don't want to lose sight of is that the underlying size of the working age population, that's a working age population that's less than 65 years of age, is growing more slowly, so that when we look ahead, we are going to see slower jobs growth. And I think with slower jobs growth as we look forward 3, 5, 10 years from now will also equate to a slower underlying rate of economic growth.
Yeah, healthcare jobs creating 52.4 thousand, government 56,000, and professional business services, as Cheryl told us, 64,000. It looks like good numbers here, but I'm hearing lots of mixed reviews. Tomas, what's the problem with this report?
Well, I think the unemployment going up is a little troublesome. I think the previous speaker said that this is a supply problem essentially than a demand. We have a lot of openings relative to the unemployed, so I think we come back to this, that this is a really low labor supply issue that's going on, of why the labor force participation, which is sort of a mix of the two, is so low. And I think that's the worrisome part on this in terms of going forward, that we're not getting workers in the workforce. Now, healthcare is typically a lot less cyclical, but there's still a recession forecast by most economists, which is very troubling despite these numbers, especially with the debt deal that just got struck last night, because CBO is not forecasting a recession, and if you have a recession, the debt to GDP ratio is going to shoot up much more than CBO projected, because revenues fall and automatic spending like Medicaid increases in recessions essentially. So the question is what's going to happen with the forthcoming recession that a lot of people are seeing coming.
Yeah, Alfredo, do you agree with that?
Yeah, I mean, I'm concerned overall on a couple of things in addition to what Tomas just said. First of all, I think this kind of sets it up for the June meeting for the Fed to take that quarter rate increase. We had kind of predicted that would probably happen. I think this actually probably sets it up even further, which then translates for us, for our small businesses, going back to the regional bank issue, tighter credit. As you know, a quarter rate increase is really a concern for our small businesses and their access to credit. And, there's a lot of discussion, for example, of what that's going to do to the regional banks. I know folks like Kevin O'Leary is out there talking about 4,500 banks probably going down to 800. But that's a real concern because that access to credit is real for our small businesses. And like I said, now 2/3 of our small businesses, according to our SBIQ poll, are really concerned about access to credit. And so what that does to the impact for employment is also concerning because, again, 2/3 of new job growth is in the hands of small businesses. So if they don't feel great about that future, that's concerning.
I totally agree. Small business is getting killed right now for a number of reasons.
Yeah.
On the one hand, you've got the stress around the regional banks. On the other hand, you've got an inability for these companies to get workers. Because of this limited workforce and this idea that productivity is going down and people don't want to take the job. So small business is getting hit on a lot of ways, Alfredo. Yeah.
Yeah, and remember, Maria, too, they're competing against these smaller businesses where the job openings, going back to the JOLTS report, which really in the 1 to 9 employees, they're competing against the Amazon warehouses, for example, which offer much higher wages for that unskilled labor force. And so that is also a big concern, and that's why they're having a hard time finding the labor that they need.
Yeah, good point. Julia, how do you see it?
Well, I think there are some reasons to be concerned for the future. In many of the most recent months, various sort of recession warning signs in the report have been blinking orange, I would say. While there was an increase in temporary help services employment this month, there was a decline in the work week. In good times, the number of weekly working hours sort of ranges between 34.3 and 34.6. We're right at the bottom of that range now. And so there does appear to be a bit of slackness in this labor market. And given how much interest rates have increased and how much uncertainty there is, I think we should be cautious about the outlook.
So, Nancy, what does this mean about the Fed? Tell us about whether or not this changes things for the June meeting, June 13th and 14th.
Yeah, so a couple of things. I run a small business, and interestingly, even though this is only anecdotal, we've actually seen more resumes for positions posted than we've seen over the last 3 years. So that may go to this whole notion that professional services actually increased this report. That's powerful. But as for the Fed, I do think we have to keep in mind that one of the caveats in the debt ceiling bill was that individuals are going to have to repay their student loans, and that's going to take $120 billion out of spending. So I think the Fed has to keep that in mind, as well as the fact that energy prices are likely to increase again, and we saw a tick up last month in inflation. We still think it's on its way down. It's always mostly symmetrical on the way down as it was on the way up, but never linear. So we are going to see some continued volatility. I think they need to stay where they are, stay pat, and let the long and lagged effects of monetary policy play out. We've only been at this for a little over a year. And so I'm hopeful that they won't take the headline numbers and they'll dig in, as Julia has, and say, okay, well, there is some concerning things in this report.
Well, that's right, because the Fed started raising interest rates last March. We're just over a year from then, and many people say that it takes a year to 18 months to have the real impact. Last we checked, there was a 75% chance in the futures market that the Fed would pause. Cheryl, what does that number look like now? Has anything changed, Cheryl?
No, it's actually stayed pretty steady, to be honest with you. I was actually looking at the Treasury market as well, because we saw the 10-year Treasury note that yield actually rose right after this report, but somewhat substantially. Also, we saw that we're seeing the dollar strengthen in reaction to this report as well. But as far as the interest rate futures and that we're staying the same as far as the Fed fund futures go, as far as what we believe the Fed's going to do. And so it still looks likely that we're likely going to see a pause based on this. But I think that I want to put the context in that we still have a CPI report to get through before the Fed meeting. And I think that's going to be more important than maybe today's report as far as Fed fund futures goes and what the Fed does. Because Powell has said in those press conferences that, they're so data dependent. He repeats that every time. But they really do turn on a dime if they need to based on the data. And I think that CPI report's going to be the big one.
Yeah, we'll see. That's next week. I'm sorry, the day before we get the Fed results on June 13th, the CPI we will be watching, obviously. Let me get your take, Julia, your thoughts on where the jobs are and what's changing in terms of this debt deal, because I'm wondering if you're going to see an increase in jobs in the oil sector, given the permitting rules that are in this debt ceiling bill that passed.
Yeah, I think it's too early to tell. Zooming out, the labor market indicators, most of them are right back to their pre-pandemic trend, and it's almost as though the pandemic didn't happen at all. The exceptions, of course, are that there was a large fiscal cost, $5 trillion added to the debt, and a large economic cost in terms of inflation. And in the long term, what we need to see, and what is not really clear yet, is whether that cost was sustainable and easy to overcome. I think will determine what happens to job creation going forward, whether that cost ends up continuing to be a drag, and whether the Fed needs to continue to raise rates to bring inflation under control. There was some encouraging inflation news lately.
All of this time, we've been talking about the impact of 10 rate hikes and expecting a slowdown, and yet employment still stays strong, Julia.
Yes, and there's still tremendous fiscal support going to this economy in the form of the CHIPS Act, which is offsetting the decline that we likely would have seen in investment in manufacturing and construction at this point. The subsidies going to green energy are also causing construction booms of industrial facilities across the country, particularly in those Sunbelt states, which are still doing very well and have sort of record low unemployment rates. There is a diverging sort of trend, though, in this economy right now. The West Coast states have seen their unemployment rates rise so much in recent months that by some rules, by sort of the SOM rule, they may actually be in a recession. So this is a very mixed economic situation, and it's a labor market where I think workers and job seekers understandably feel a little bit off balance.
Yeah, I mean, mixed story, Tomas, but still showing strength in job creation. Why do we have this worry about a recession and a slowing economy later in the year when we continue to see job growth?
Well, all the leading indicators are indicating it, and the credit squeeze that we're also seeing universally across all credit markets, corporate, individual, whatever you have. So I think people are rightly worried about that. And the real question for the Fed is not so much 25 basis points in June or not. The real question for the Fed is what are they going to do if we tip into recession, because we're going to naturally have lower government revenues and higher government spending in that recession. So their balance sheet, they had a huge balance sheet to try to get it down. Then the banking crisis came and it went up again. they're never going to get rid of that balance sheet, it looks to me. And if we have a recession, the question is, what is the Fed going to do in terms of stepping in with its balance sheet?
Yeah, it's a great point, because John Lonsky, there are some out there who think the Fed is going to cut at some point this year.
Yeah, that's what the Fed funds futures market still thinks, and that rate cut may not happen until November of this year. I want to add that the Fed funds futures market, while it assigns roughly the same probability to no rate hike come June 14th, has increased the assigned likelihood to a rate hike at the following FOMC meeting that takes place on July 26th. But still, they're looking for that first rate cut to come November 1st, and another one come the December FOMC meeting. You know, in the event of a recession, we'll probably be looking at considerable downward pressure on wages, and as a result, the Fed will be cutting rates regardless of their still huge balance sheet.
Well, regardless of whether or not we get a recession, Joe Concha, the White House will tell us it's not a recession because we actually had 2 quarters of negative performance, and they told us, oh, no, we're going to change the definition of recession. It's not really a recession.
And we've seen that movie before, as you said, and those like Paul Krugman over the New York Times will say, no, we're going to redefine this now. 2 straight negative quarters means not a recession because a Democrat is in office, obviously. But the economy will be the number one issue going into the 2024 election. And when you look at polls, for example, when asked who will handle the economy better in the next presidency, Donald Trump easily laps Joe Biden on that front. So I would imagine you'll hear the former president and all the GOP contenders talking more and more about the fact that even though the president can tout these numbers today and say, look, the unemployment rate is still below 4%, at the same time, the American people's perception of the economy is far different at this point because they still feel the cost of buying food and apparel is far too high for their pocketbooks to keep up with. The final stat I'll share with you is that 66% of Americans could not afford a $1,000 emergency if it presented itself. Those are real problems, and that's what's going to be at the forefront as we move ahead in this campaign, Maria.
Yeah, and you know, I mean, the timing is not great because if we're seeing, for the White House, if we're seeing a slowdown later this year going into 24, which is an election year. Nancy Tengler, this market has totally surprised a lot of people, though. You're still seeing gains in stocks. What do you want to do from an investment standpoint after this report?
Yeah, I think you want to continue to be disciplined in your investment process because we are going to get a lot of chop. There'll be a lot of volatility around the Fed funds meeting. Then we go back into earnings season at the end of July. So we've been using the volatility to add to high quality names and not flee the market. One of the things we tell our clients all the time is don't let the market scare you out of stocks because over the long term, this is where you want to be. And great management teams are really showing up and delivering even on margins that have come down. They're still at pretty high levels versus history. But the last thing I'll say is watch the manufacturing PMI. It looks like they're trying to bottom. We got the report yesterday. What was interesting to me in the report is that prices paid went down from 53.2, which is expansionary, to 44.2. So that's deflationary, and I think it should be something the Fed pays attention to. And ISM manufacturing employment was actually much stronger than expected. So that's positive because corporate earnings are positively correlated to the ISM manufacturing numbers. So if we start to see a tick up, that's going to be very helpful to support stocks through the end of the year.
Yeah, it's a good point. The ISM and purchasing managers indexes are market movers. But Alfredo, you look at this report, factory jobs were down.
Yeah, absolutely. I mean, they were. And, you know, one of the concerns is going into the third quarter and fourth quarter, Maria, is that when you look, and in fact, I think earlier in the report you talked about, I think it was General Mills that's taking up their price increases, and they said that they buy their products 6 to 9 months ahead of time. Those contracts really are flowing through as we speak, and so they're going to start, you know, seeing those higher commodity prices really flowing through off their balance sheets onto their P&Ls. And so I'm concerned about the earnings going forward for these companies, and they're going to have to probably keep taking those price increases, which then, of course, translates into higher inflation and stickier inflation for our consumer while wages are going down. So, again, doesn't bode well, I think, for the average American.
So what are you watching then, Alfredo, in the coming months this summer? What are going to be the more important metrics that you focus on?
Yeah, absolutely. I mean, as we look through our Small Business IQ poll, again, that's the sentiment of the small business. And so, again, as we look at large businesses and they're doing the layoffs, they're preparing for that. You know, small businesses still haven't been able to hire the labor force that they want, but they have gotten comfortable, relatively speaking, with the force that they have because they've had to do that. And so going forward, as it gets softer and softer, I'm going to start looking at the sentiment of our small businesses going forward in terms of their interest of hiring into the third and fourth quarter.
Yeah, and Cheryl, it looks like the market's going to be focused on the inflation story going into the Fed meeting. You mentioned the CPI earlier. What's the expectation there? We're way down from the 9.1% number at the peak of inflation, Cheryl. That was the 40-year high, but we're still double what the Fed wants as a target.
Yeah, the last estimate I saw for CPI, and this may change before the report comes out, was just under 5%. But, you know, I think the core PCE that we got last week, the PCE price index numbers we got last Friday, those were actually pretty stunning. So I have a feeling that, you know, as far as CPI goes, I have a feeling that the core number is going to be a much more of a market mover than the headline number will be. But we shall see. I mean, we have seen food inflation come down. In particular, like we talk about eggs a lot, you know, that number is way down from where it was, you know, 3 or 4 months ago. But, you know, still, and energy prices have actually not really risen as you think they would. Oil has actually been pretty tame over the last few weeks. So, you know, but I still think that CPI is going to be the true report that they're going to look at to make their decision. But again, and I keep checking Fed funds futures. I know Lonsky was talking about the longer-term bet for a cut in November, but we're still sitting at 75% chance they pause in June.
Tomas, your thoughts?
Yeah, I think that the Fed is going to essentially. The main thing with the Fed, like I said, is not the rate so much, and I'm not worried about that as much as I am about the balance sheet. But I think this inflation is very sticky. Like the core inflation has been very, very sticky, more sticky than people thought initially. But this inflation period, I think, is going to be sort of a vindication for Milton Friedman. Milton Friedman was actually my grandfather and intellectually my mentor. Milton Friedman was my mentor's mentor, essentially. And, you know, if you look at the money supply, it had a huge peak and then come down, and we had a lagged response in inflation exactly following that peak in the money supply, essentially. People didn't believe him, you know, in the financial crisis because we had money supply not being so important. But I think this inflationary period is kind of looking like that. And I think it's going to come down, particularly with the recessionary pressures that are coming forward.
Yeah. Julia, same question to you. What's most important here as we look at a market that is celebrating this report up 205 points, even though it was better than expected, and could lead the Federal Reserve to keep on this rate-raising string?
So the best thing about the post-pandemic labor market has been the gains it has delivered to the lowest wage workers. And you know, while workers overall have seen their real wages fall 5% below the pre-pandemic trend, the lowest 10% of workers, the lowest 10% of earners have actually seen 6% wage growth above inflation. In this report, though, you know, what we all know is that those workers will be most vulnerable in a downturn. And in this report, the black unemployment rate, which hit an all-time low last month, rose by almost a full percentage point. And so I think watching these household measures and watching the most vulnerable workers and how they are faring in this labor market is the most important thing.
All right, we will leave it there.